Are you a non-resident Indian planning to move back to India, or have you already made the move? Then you might perhaps be worried about what you want to do with your foreign currency earnings or how to manage your existing Indian bank accounts. Worry no more, because I will introduce you to something called Resident Foreign Currency or RFC account in this video. So keep watching. First, let me start with what an RFC account is. Simply put, it's a savings account designed for NRIs who have returned to India but are not ready to convert their foreign currency funds into Indian rupees just yet and wish to maintain their savings in foreign currency. It's like a safe haven for your foreign cash, whether in the US dollars or euros. Plus, depending on the bank you choose, you can keep it all in the currency of your choice, hassle-free. And you can convert your foreign currency into Indian rupees whenever you wish to at the prevailing exchange rate. Remember, you can open an RFC account only when you have been away from India for a year or more and decided to make the move back home permanently. But once you have made the switch to being back in India, you can no longer operate your non-resident external NRE or foreign currency non-resident FCNR account. But don't worry, you can smoothly transfer the funds from these accounts straight to your RFC account. Now, who can get their hands on an RFC account? The list includes NRIs, persons of Indian origin, or as we call them PIOs, overseas citizens of India or OCIs. If you're an NRI receiving foreign exchange remittances, whether it's from your pension, salary, or proceeds from selling your assets abroad, you will need an RFC account to manage these foreign income in India. Now, who is eligible for this? NRIs or OCIs who've returned to India on or after 18th April 1992. NRIs or OCIs who've stayed outside India for at least 1 year before their return. NRIs or OCIs who have moved permanently to India. Next, let me take you through the different types of RFC accounts. You have savings, current, term deposit, which can be maintained for 1 to 3 years. You can hold them in your name alone or jointly with another eligible person. So what makes an RFC account so useful? RFC accounts can be opened by any returning Indian. You can withdraw cash in Indian rupees from your branch. There is no need to stress about converting your foreign currency earnings into Indian rupees with RFC accounts. You can stash your cash in the same currency it came in, shielding yourself from fluctuating exchange rates and potential losses. They're fully repatriable, which means you can transfer funds from any foreign country hassle-free. Plus, you have got the flexibility to convert those funds into Indian rupees whenever you want to at the current exchange rate. Wait, there's more. Your RFC account is not just for holding cash. You can also use it for a bunch of other stuff. Whether you're paying for expenses in India or abroad, investing in shares, securities, or mutual funds domestically or internationally. You can also use it to make donations or gifts to your loved ones or charities at home or abroad. And here's the cherry on top. Your RFC deposits are covered by the Deposit Insurance and Credit Guarantee Corporation (DICGC) up to 5 lakhs per depositor per bank. There are tax perks waiting for you with your RFC account depending on your residential status and where your income is coming from. If you're a resident but not an ordinarily resident RNOR in India, you are in luck. You can score exemptions from taxes on the interest you earn with your RFC account and on any foreign exchange gains or losses that pop up along the way. If you find yourself as a resident and ordinarily resident in India, you are still in for some tax perks with your RFC account. You can enjoy tax exemptions on the interest you earn, but there's a catch. It applies only if your income is coming from specific sources like pensions, dividends, interest, etc., all from abroad. So while you are managing your finances, you can also save a little on your taxes along the way. If you're thinking of switching gears back to the NRI status, then you can easily move the funds from your RFC account over to an NRE or FCNR account. It's like a seamless transition, ensuring your finances stay flexible and accessible no matter where life takes you. RFC Fixed Deposit is a feature of the RFC account. It's like a time-bound savings account where you can stash your foreign currency cash and watch it grow with interest. You have the freedom to open one with any currency supported by the bank or RFC accounts. The duration of your RFC fixed deposit can be tailored to your preference, ranging from 1 to 3 years. Plus, when your deposit matures, you can either renew it or cash it out depending on the bank's rules and regulations. Premature liquidation of RFC deposits can attract a 1% penalty. Let me take you through a simple step-by-step guide to help open your RFC account. Getting your hands on an RFC account is easy. Just go to your bank or check online for the account opening form. Fill it out, gather the necessary documents, submit everything to the bank. KYC documents: the proof of identity, address, PAN card or Form 60 if no PAN is available, passport and photographs. Then the proof of your NRI status, your visa, work permit or employment certificate. The proof of returning to India, your passport entry stamp and tickets. RFC declaration form. The bank will open the RFC account and provide details to the customers after all the documents are verified. Once your RFC account is up and running, you can wire, transfer, use foreign currency checks, or even transfer from existing NRE or NRO accounts. Remember, you can manage an RFC account using only three main currencies: dollars, British pound, and euros. Now, you might think that managing your RCF account can be an additional task. No, it's actually pretty straightforward. Just fill in the application on plain paper and you can withdraw cash in INR. For identity verification, bring along a valid passport copy or any other photo ID like your driver's license, your voter ID, PAN card, or employee card. The foreign currency balance will be converted to Indian rupees based on the current rate, and then you can either pocket the cash or have it credited to your rupees account, whichever floats your boat. And if you're withdrawing 50,000 rupees or above, make sure you've got a copy of the PAN card with you. Now, what are the types of credits or inflows permitted in an RFC account? Once you're back in India permanently, you can easily move the money from your NRE or FCNR accounts over to the RFC account. Any money you make from your foreign assets, whether it's pensions, dividends, or interest. You can deposit personal checks from foreign accounts, your traveler's checks, your foreign currency notes into your RFC account. If you have sold assets overseas like shares, property, business investments, etc., you can bring that foreign currency back into India and deposit it into your RFC account. If you have received money as a gift or inheritance from a relative, you can deposit that also in this RFC account. Funds received from a life insurance policy claim, maturity or surrender values which are settled in foreign currency by an insurance company in India authorized by the Insurance Regulatory and Development Authority. Let's now shift focus to the types of debit or outflows permitted in an RFC account. You can easily move your money from your RFC account to your NRE or your FCNR accounts if you choose to become an NRI once again. If you need to send money overseas to make investments abroad, you can use funds from this RFC account as well. You can use funds from your RFC account to support your dependents or for personal expenses abroad. You can also utilize funds from your RFC account for expenses or investments within India. You have the option to withdraw funds in Indian rupees by transferring the foreign currency from your RFC account to a resident CASA account. To access this feature, you will need to open a resident INR CASA account. Whenever we decide to open a bank account, one of the first things that pops into our head is tax implications. Let me simplify the tax rules for RFC now. Depending on whether you're a resident but not ordinarily resident in India or not, you might catch a break on taxes. If you fall into the RNOR category, you can snag exemptions on the interest you earn from RFC account and any gains or losses from foreign exchange. This usually lasts for around 3 years after your return to India. If you're a resident and ordinarily resident in India, then you're on the hook for taxes on the interest you earn from your RFC account, no matter where the income comes from. But here's the silver lining. If you've already paid taxes on that same income in another country, you can claim relief from double taxation. It is all part of the Double Taxation Avoidance Agreement or DTAA between India and that particular country where you've moved back from. Now that is a lot of information to process, right? So let's do a quick recap. An NRI who's planning to move back in the country or has already moved back can open resident foreign currency or RFC account. It's a savings account for NRIs who wish to maintain their savings in foreign currency. You can convert your foreign currency into Indian rupees whenever you wish to. You can also withdraw cash in Indian rupees. You can easily move your money from RFC account to NRE or FCNR accounts if you choose to become an NRI again. This account can fund your expenses both in and outside of India. Alright, so that's it. It's time to wrap up this video. Hope I've answered all your questions regarding RFC accounts. But if you have any more questions or doubts, feel free to drop them in the comments section. And before you go, please note that this video is for educational purposes only. Any information mentioned in this video is not an endorsement or investment advice. If you found this video helpful, don't forget to hit like and subscribe to Groww NRI.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.